the juice is going to be worth the squeeze. It's just going to take a long time.
Hello, everyone, and welcome to another episode of Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I am Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we're hosting the conversations you won't hear anywhere else. We're going to pull back the curtain on how to make housing more innovative and attainable.
And we're super happy to have Built Rewards continuing to sponsor these smart conversations. But if you have ideas for guests or a show or are interested in sponsoring an episode, please email us at podcast@thehousinginsiders.com.
And if you like the show, you've heard this before, you've heard it from everyone. Reviewing and spreading the word actually really does help our podcast. And so we're going to say it again. Please subscribe and please share these episodes with your friends and your network and your colleagues as well.
All right, let's turn to the headlines before we get to our special guest of today's episode. I want to start with actually several headlines that have been coming across my news feed, Jeremy. I imagine you're seeing it. This idea of a 40-year mortgage as a solution to the housing issue. I've even seen 40/50-year mortgage. Jeremy, let me just tee that up. What are your thoughts about a mortgage with a longer term?
I'll say this. While I understand the motivation to try to help people and keep monthly payments low, that is a good motivation that I can understand. I think this is lazy. I don't think it's a real solution. I don't think it's a thoughtful solution. I think it's more just, let's just do whatever we can do. And it's grasping for something that doesn't have to change anything all that much to happen, as opposed to being honest and really making people drive to a solution that is much more sustainable for the whole system.
Yeah, I agree with that. And I think there's ways to make this workable, and maybe we can mention a couple of those, but I'll just start by saying, like, we don't need more demand side solutions. You know, the more we come out with ways of making mortgages cheaper, the more we're going to increase housing demand, and the more home prices are going to go up and become less affordable, despite the fact that we're trying to make them more affordable. And by the way, this is not a new solution. You extend terms, you lower the payments. Prior to the housing crisis, when I was at Fannie Mae, we spent a lot of time looking at 40-year mortgages, 50-year mortgages, or if you take that all the way to its limit function, an IO mortgage where you're only paying interest for a certain period of time to lower housing payments. And again, it's not really solving the fundamental problem, the supply challenge. It is exacerbating that by just pushing more on the demand side.
Yeah, we're looking for those solutions that actually, fundamentally change how we think about the structure and not just take the structure and stretch it to its limit.
Yeah, I'll throw out a couple of ways to make this workable, which I don't know if I've seen necessarily written in the headlines, but a 40 or 50-year mortgage right now is not, I don't believe, is securitizable into a 30-year MBS security. And so, immediately you're facing a liquidity challenge if you're going to do this at a small enough scale where it's not going to be impactful to demand. And so the first thing that you probably need to figure out is whether or not MBS rules can be modified to allow for a longer term mortgage as a de minimis share of existing MBS or Ginnie Mae security. So I would say that's one thing that you'd have to do. And then secondly, to keep volumes low, if you're going to create a product like this, the goal should be to target people that otherwise could not afford a home, not to give this sort of as a product to everyone. And so I would recommend we really be thoughtful about where a 40 or 50-year mortgage should be targeted and how we manage to, get it to people that are, for example, first-generation home buyers. But again, we're talking about a more susceptible to risk clientele, and they're building equity more slowly. And so, if you get it to the right people, how do you put the right safeguards? So I think contain the volume, make it eligible for existing securities, and maybe you have a solution here. But I will say that's not an easy path to go down.
I'll say one final thing on that for this topic, which is, apropos for today. And our theme today, which is if we can get new home buyers who wouldn't have had equity at all into something that gets them a similar amount of equity as they would have had they been in a 30-year fixed mortgage, then I think it kind of is a wash. To your point, you don't stay in your mortgage for 30 or 40 or 50 years anyway, typically. So if we can get net new homeowners into something that earns them the same amount of equity they would have earned, gets them in the game, there is a silver lining there.
Yeah. And going back to these solutions, I think is just we're trying to do it because we can't fix the supply issue. And the longer that we go on without fixing the supply issue, the worse the equitable problem gets. It just, the haves get more, the have-nots don't get more. And so I just feel like a little bit of a desperate attempt, but maybe used in the right way, could be a sort of short-term solution to the inequality we're seeing in housing. Let me pivot. Jeremy, you were recently at the Housing Wire IMB Summit, and I would love to hear what your major takeaway was from your conversations there.
I'll mention two. On one side, a lot of positive energy. And one of the themes I heard from mortgage companies was don't forget to get back to the basics. In this type of market, it does require doing all the things right, doing the traditional referral sources, operating and processing loans efficiently, closing on time, meeting the expectations of customers. So there was a nice theme and positive energy around back to the basics. I think the other side of that coin was a fear that the big players, the digital lender servicers, the technology enabled, call it top 10, have acquired a lot of servicing over the last few years. And one theme I heard from a lot of mortgage companies was how the servicers are getting better and better at retention, making proactive refi offers before that customer even shops. And I think there's a real threat that a lot of mid-size or smaller players counted on lower rates to boost volume in the fourth quarter of 2024, only to find out that the big servicers stepped in front of them and made offers before they could. And as we see retention numbers at the big companies grow, what that means is more pain and fewer loans for the people that were counting on them in the mid-market and smaller community IMBs. And their thought about lower rates bringing them volume might have actually been a little bit of a false narrative. And so you got to cut your rate then even further to try to win those loans, which crushes your margin, and it ends up you make less money on more volume because you have to compete with these large servicers who acquired the loans over the last few years and are getting really good at making proactive refi offers.
That latter point is really fascinating. And, even servicers have gotten good at anticipating turnover. So it's not just refi offers, but even people that are moving, they're getting better at targeting that audience. And this confluence of the consolidation of MSR ownership and servicing, the improvement of technology to be able to anticipate consumer moves, is really going to put more of the business back with the original servicer, which they're going to love, which they've been trying to do forever, but is really starving the rest of the market. That's a very, very interesting takeaway. And, just to plug, Housing Wire does amazing things. I really wish I could have been at this summit with you, Jeremy. It sounds like it was a super useful event. So thanks for sharing your insights.
Right on.
All right. Well, today I am so excited to introduce our guest. We are going to be talking with the co-founder and chief strategy officer of Pathway Homes. Welcome, Casey Cleary. Pathway Homes, obviously one of my favorite organizations. For those that don't know, I spent a little time there working with Casey as the company was getting started. So Casey, welcome. And I guess just to get started for our listeners, would just love to hear a little bit about what Pathway Homes is, a little bit about the sort of rent to own trend that we've seen really in the last decade. So.
Absolutely. Well, first off, thanks for having me. Great to see you, John and Jeremy. I'm excited to be a part of this. So what is Pathway? Pathway is a platform. Our mission is to help people become homeowners. And we've started with our rent to own products where we can get folks into a high quality home and give them a path to homeownership. They have an option to buy the home from us, and they have property management from our partners at Invitation Homes while they're living there. So they don't have to worry about repairs or things along those lines, both from the perspective they have to fix it themselves or the cost of doing so. And the idea is folks move in and they have a path to homeownership. They can buy the house that they're living in if that's the right decision for them down the line. And we give our customers another option on that path. More broadly, the trend on rent to own, it's been a pretty big trend over the last 10 years, call it, between some of the larger players, Home Partners of America, Divvy, there's over 20,000 homes between those two companies. Home Partners obviously purchased by Blackstone a few years ago. Divvy grew, really quickly into the pandemic as well. And I think what they're tapping into is a need within the US and certainly within the customer base to find an alternative between renting and owning. And really giving people that other option, that other way to do it aside from just straight up full ownership.
One of the things that you just mentioned was the being in the house part. So there's the obtaining the house, and then there's the property management, fixing, and cost. Can you talk a little bit about what are some of the biggest reasons or variables you see your customers choosing this model, or that you've identified as the key variables of why? Is it about the once you're in the house part? Is it about getting in the house? What are some of those key things you're seeing in this trend?
Yeah, totally. You're totally right. It isn't just when you're in the house and the expenses there. I think for a lot of customers, first-time home buyers, would-be home buyers, the prospect of purchasing a home is daunting. There's so many things that are unfamiliar, uncertain. So getting into the home itself is a big part of the challenge. And certainly in periods of time over the last 5 years or so, when, especially on the existing home side, it was just a really tight market. And if you're an individual consumer, let's say you have FHA financing, you could lose, even though you had the highest bid on a home, because you're competing against an all cash offer or someone that can close quicker or is, waiving their inspection rights. So I think that's a big part of the story, just getting into the home. I think related to that is just getting into a quality home. A lot of times you could win a bid and become an owner of a home only to learn that there's all this deferred maintenance that you didn't uncover until you got into the home. And so I think providing access to quality housing, and also, which is access and quality. And then also, once someone is a homeowner, there's a whole host of things that are not anticipated either. The recurring capital expenditures, maintenance costs, taxes, insurance, all these things can be, new to a first-time home buyer. And, just the financial literacy that goes into that. I think, unfortunately, it's uneven across the U.S. in terms of people understanding that.
That was awesome. And there's a lot to unpack there. Let me start with something that people also often levy against sort of the market of buying up homes and renting them out. The sort of more applicable to single family rental, although I wouldn't be surprised if Pathway Homes is sometimes a target of those accusations. And generally what I've seen and what the research really shows is that people that are renting homes, and I imagine people that are attracted to the Pathway model, are actually people that are really going to struggle getting a mortgage. So it's not a question between owning a home and renting a home. It's the only option they have is to rent a home or rent an apartment. And really what you've created is the opportunity to rent and have the experience of being in, to your point, a quality single family home. So that being said, I'd love to hear a little bit about how you underwrite people that are entering in the program. And what are the demographics, some of the underwriting challenges, the income levels, the credit? Just tell us a little bit about the consumers that you're seeing that are opting into this model as their choice.
It's a great question. And I think, as you think about what success looks like, ultimately success is you have people that are purchasing the home from you, full stop. But for that to happen, you really need a lot of things to go your way. And the best way to make that happen, there's two sides to it. One is you bought the right home and it's a good investment for you. It's a good investment for the customer. And when it comes time for them to buy, that home is, in the money, and it's been good for everybody. I think your question is really more on the customer side. What does it take for a customer to be ready to buy? And how do you solve for that on the way in? Some of the companies in the renttoown space, I know we'll probably get into some of these later, they've just done a terrific job of finding customers that are genuinely on the path to doing that, as measured by, their savings, or their ability to save, their income, and their ability to cover their payments, both while they're in the rental part of the program and then ultimately when they convert to ownership. And then last, certainly not least, credit. Like, you guys could probably have a whole separate thing around like FICO scores and all the rest of it. But, for a lot of customers that come in these rent-own programs, historically, they've been targeted at folks with lower credit scores. And I think, say what you will about the different credit scores that are out there, all things being equal, you kind of have to have a credit score of a certain type. And that's certainly correlated with other factors that are aligned with people becoming a buyer down the line. So on our side, we have a credit minimum. It's stated at 620, but we have a lot of things that we do to work with customers down to 600. And oftentimes when customers first present to us, they're below 600 at a household average level. Yet we can work with them, get them above 600, and continue to work with them over time so that they're building credit. That's a big part of the story. Second, on just the savings and the ability to save, those are obviously related. again, there's a lot of misconceptions in the customer base. Oh, I have to have 20% down. It's like, well, no, you definitely don't. And we work with customers to work through that. Demographically, to that part of the question, our customers, they're pretty lumpy in that, call it 30 to 45-year-old age range. So well over half of our customers are in there. On an income basis, in general, we're above the median incomes in the markets. The median income in the markets where we're operating is about 85,000. We're above 100,000, and in some of the markets, well above 100,000 in terms of our income. So on average, our income coverage, which, to get into a rental, traditionally it's 3 times income coverage. We're often closer to 4 times, sometimes higher than 4 times income coverage, which is great because that means our customers are going to have no trouble paying their rent regularly with us. But more importantly, they're going to be able to save if that's what they want to do on a monthly basis because they're not plowing too much money into housing as a share of their income.
And just a quick follow-up on that, Casey, are they families, young couples? What kind of stage in life do you find people in?
So we have a very long, fat tail. So in general, you're going to have a family. A lot of the intuitive sense is, okay, people are moving into single family rental because they need more space. They want a garage, a yard, et cetera, and the walls are caving in on them in their apartment. We very much see that to be the case with our customers, whether it's, starting a family, growing a family. A lot of our customers have pets. So that's a big part of it, but that's not all of it. And there's a lot of folks that choose to rent. I think behaviorally there certainly is a trend that, I can get into a nice house and I can have someone just take care of things for me. And that peace of mind is really valuable for a meaningful portion of our customer base. That part of the customer base likes having the knowledge that they could buy this home down the line, but it's not entirely clear that that is their end objective, though it is important for them.
Looking at where we are today, with rates having gone up so much, and in a lot of cases, mortgage payments being higher than rental payments, in some ways, it's not the ideal time for being in the rent-to-own situation. How are you seeing the development and the ability of people to buy the home that they're renting? Is that option price as compelling as it probably was a few years ago? Are interest rates really kind of making it really challenging to make that conversion? Just give your observations in the market today.
No, totally. You touched on a lot of great points. I think ultimately the ability to buy on the macro side, if you have a fixed price option, like the Pathway customers that are looking at their homes now do, is the home in the money or is it close? And depending on the vintage and when the home was bought or when they moved in, a lot of our customers will be in the money, but some of them won't be. Some of the homes that we bought at certain times in our history, they're in markets that were, kind of booming in the pandemic. And unfortunately, those homes won't be in the money. So on that side, there's things that we've put in place where we can still be of service to customers. So even if this home isn't in the money, let us use our scale. Let us use our relationships with builders and the access to resources that we have to help you figure out when and what might make sense for you going forward. So, even when that doesn't work out, we strive to do everything we can to fulfill our mission and to help people on that path to homeownership. Now, on the customer side, it totally helps if interest rates go down and, the ability to finance and buy a home is there for a customer, both in the sense that they would underwrite from a mortgage perspective, income coverage and debt to income and all the rest of it. But secondly, just that the monthlies are in line with what they can support realistically, even if they do underwrite. We have lots of customers that can underwrite and, move into certain homes, but they just don't want to because the payments are too high. So I think that's going to be a big part of it. And, I don't have a crystal ball in terms of, where rates are going. And I mean, there's been some funny commentaries out there on what that looks like. But, presumably there will be a normalization in rates where they would go down over the next period of time. I don't know, call that 1 year, 2 year, 3 years. And a lot of those customers that have those options will be able to exercise those and, become homeowners.
On that note, let's take a quick pause. We'll get a brief word from our sponsor. And when we come back, we want to talk about some of those larger trends you mentioned around, single family rental and shared ownership.
This episode is brought to you by Built Rewards. Built is a rewards program, just like an airline program that is centered around your home and neighborhood. But instead of earning miles for flying, Built rewards you for paying rent, no matter how you pay. As a member, you can earn points at over 20,000 local restaurants, local merchants, and those points are now the most valuable rewards currency. You can use it to book travel, on Amazon, or even towards a down payment.
Built is revolutionizing housing. If you want to learn more, email John at lawless@builtrewards.com.
All right, welcome back. We've got Casey Cleary with us from Pathway Homes, and we're going to pivot a little bit into sort of a broader discussion about these various models, fractionalization of home ownership. And I wanted to start with something that, Casey and I worked very closely on when I was at Pathway Homes, which is this concept of a new model that has various names. In the UK, it's part rent, part own is one way it's called. Shared ownership is another term that gets used. But Casey, can you talk about that particular product offering that Pathway is working on and where you guys are so far on it?
Just zooming out on shared ownership, I think, intuitively for folks, the home purchase is by far the biggest purchase anyone will make. 10x the next biggest purchase, usually a car. And with something of that scale, you kind of think about it. It's like, does it totally make sense to go almost 100% levered on the biggest purchase I'll ever make? Part of the rationale for shared ownership is, look, why not just buy part of the house? There's all these institutional players out there that can facilitate a transaction like this, where you buy part of the house, we'll rent the other part back to you. And just simply doing it in that way unlocks so many other aspects that are attractive for customers, as well as for capital out there. There's lots of other fractional options that are out there. I know we'll go through some of those, but what I really like about shared ownership is the fact that you actually do own part of the home. Depending on how it's structured, you have a titled interest in part of the home, and that can be a store of wealth for you and your family, and a way to generate wealth in a household over time.
Yeah, this is one of those things that I'm excited about. Our friends and audience that listen to Housing Insiders know that I've been talking a lot about exactly what you said. How much home do you want to buy? And the fact, to your point earlier, other asset classes have been training consumers for these smaller on-ramps and smaller pieces of larger returns, larger outcomes, and bigger asset classes. So the time is right. Customers have been trained that you can get these smaller pieces of a larger thing, and that's better than waiting longer to try to own more, which may or may not ever happen. However, we're not good at nuance. Like, as people, we're not good at complicated, and technology is helping with some transparency and clarity. What are some of the lessons you've learned or some of the barriers you've run into around those nuances that you think are actually addressable in the next few, quarters, years, as we all try to tackle this really valuable thing for future homeowners?
Oh, totally. And I think it does come down to, how do you access and work with the existing infrastructure and the existing ways of financing, things like this. I think the reality is, so a shared ownership, it's going to be a non-QM investors are looking for incremental return over what they could otherwise get, even in the non-QM space. To deliver that type of return for the type of people that would get started on shared ownership, they're going to be looking for a little bit of extra return. And typically those non-QM buyers, they're looking for huge amounts of origination, right? Like their minimum order quantity for, a pool of loans or something is in the hundreds of millions of dollars. So if you want to deliver shared ownership, you kind of have to do it at scale to get the right type of pricing, for the loan. So there's a little bit of chicken and egg on shared ownership. Now, I think that the investors are out. I think the product is there. The value proposition is there for the customer. That is, I think, an open and closed case from my perspective. I think navigating the investor market and finding someone who's willing to get started on it so that you can get to that big first, pool requires, a platform that's able to originate. It requires, which by the way, that is there. That, we have partners that we've been working with who are just terrific. I'll name drop Service First Mortgage here in Texas. What a great organization. So that part you can solve. Working with investors, I think the product from an investor perspective is there. You just need it at scale. I think finding customers, that is also doable as well. I think the challenge for rent to own and for shared ownership is just getting the right supply, so that you can do it and structure the platform in a way that can originate it at a large scale. And that's a big bet. Someone's going to have to make and place and support a big bet over time. with, a very high level of conviction that can happen. And for that to be the case, all those stars have to align for the investor, for the person supporting the platform that's doing this. I mean, I believe, I'll say that those preconditions are going to be in place in the next few years, if they're not already, and that the opportunity to do this at scale. And when I say at scale, I'm not talking about, like a few thousand homes. This is tens or hundreds of thousands of homes and billions of dollars, because it is a scaled way to do it. To really unlock it at a huge scale, I do think you're going to need the GSEs to participate, because that's only going to lower the cost for consumers and make it more attractive for a larger set of institutional investors to invest in shared ownership instruments. But I think all of that is possible. I really do.
Yeah, you touched on a lot of the core challenges of taking one of these models to scale. So I want to unpack a lot of it, because I think there's no end to the number of companies Jeremy and I talk to that have some really cool, albeit complicated, but cool ways of accessing partial ownership. And we've seen it in the second home market with Picasso. We've seen it in the investment market with Bruce Stock and other companies. But as we look to it in the primary ownership market, it's really hard to get off the ground. And I often think the struggles are, how do you get financing for the consumer if they're going to buy a meaningful share? And so you touched on some of the mortgage challenges. How do you get capital for the company that's patient enough to allow the business to scale over the period of time it needs to? And then lastly, how do you even get to customers so that they're aware of the model, so you can have a conversation with them so they can take advantage of it and get to them at scale, and not at a customer acquisition cost that just totally ruins the business model? So I wonder, we can take each one of those at a time, but if there's one that you see as boy, this has really been a central challenge for us, we could start there, but I'd love to unpack all of those challenges for the audience.
Totally. Yeah. So, we'll take them one by one. We'll do lightning round. Financing for the consumer, right? They've got to get underwritten for a mortgage. So, whereas with rent-to-own, you don't have mortgage underwriting on the way in. With this, you do. You do have to get a mortgage underwritten. Now, if we've already bought the home, or we're the buyer of the home and then moving the customer in, the other part of the challenge is easier. Yet getting a consumer underwritten for a shared ownership mortgage, you've got to do a lot of product work to make sure you have everything in shape to originate a mortgage, to get title, and to have all that stuff sorted out. I can say confidently that that's all doable, because we've spent a lot of time on that here at Pathway, and we won't be the only ones over the long run.
Just to take that for a second, you talked about non-QM buyers and the needed scale to get those rates to be meaningful, right? I mean, the product is incredible. You have somebody's buying a portion of a home with an institutional investment company that's maintaining the home, that's going to help them in the event that anything bad happens. So you really have a low risk, high returning thing. And yet still you need to charge more yield initially to get the financing going. And so as much as you have partners, it's still not the best rate, not the ideal rates. And you're going to need to kind of wait until a non-QM, or to your point, a GSE market can really help that part of the business to scale.
That's correct. Yeah. And that's just because that's how the world works. If you're sitting on that desk buying, loan books, it's wait, why did you buy these? We didn't get anything extra for this. What are you doing? And that's just the way the world works. It's economics. And we understand that. I think you actually have to embrace that. That's how to get this done. You have to do it at a large scale. And like you said, the fundamentals of these instruments are really strong. Those investors are out there, and you just have to show up with, a really large loan book, but you have to find a way to create that loan book in the first place. So that's where a little bit of the chicken and egg happens. On the capital and having patient capital, that's where we were going next, right? So how do you have a platform that can originate this, can facilitate and support these partnerships and do it, right? It's going to be, the right kind of patient, long-term platform building investor. And so, we've been really fortunate at Pathway for the investors and backers that we have. They get it. They've been around the block. They typically have a low profile on things that they've done, but the Regis Group has an incredible track record of what they've accomplished for a long period of time. So they're very patient. They're waiting for the right time to do these things. I think there's certainly opportunities to do shared ownership type things at a smaller scale, potentially with different types of capital buying the instruments and supporting the management of the homes. but I don't think that will get to the type of, mega scale that's required to really move the needle on residential in the US, just given, how large scale the existing programs are. I think ultimately you have to take a customer that wasn't considering this because they don't know it exists, make them aware of it, help them through the decision process with a new product in a new market with new types of objections and so forth. So that's going to be a little bit harder. And I think, in a world where you've got to do this and find a way to make it scalable, that is one of the big challenges for shared ownership. I think the success in the UK really helps. They've been solving this problem since, shared ownership has been in existence in the statute since, I think, 1980, I believe. But it's really scaled more recently because they're fighting the same problems in the UK. In some cases, it seems like it's worse over there as far as supply and access to good housing. So I think getting customers to make them aware of it, it takes a long time. And over the last 5 or 6 years in the UK, the for-profit registered providers have done a really good job of doing that. And they're doing that by providing value to the home buyers, providing value to the lenders, and very much so providing value to customers. There's government support in different forms and functions over there. Without government support for it in the US, you really have to find, the right entry point and the right place to make it happen. And that is certainly a challenge. But, with the right product, with the right process to educate customers and get them into quality homes, I think it's a natural extension of, that yawning gap between renting and owning, filling a meaningful portion of it with shared ownership and shared ownership-like products.
I agree. Casey, this has been great. I mean, you're talking really about creating more of an economic engine for more people. And that really gets me excited. At the same time, we know that what we're really talking about here is now more demand. We've seen a rush for real assets, whether real assets meaning land or houses. And we've seen capital want to go towards real assets like land and houses. So that means individuals, first-time home buyers, rent-to-own owners, investors are all rushing at the same time to get at this asset. And so what we hear then on the other side of that coin is, well, isn't this going to drive up the cost of home ownership? Isn't this going to drive home prices up over and over again? And I'm just curious, what's your take on that? What's your outlook? What do you tell people? What would you advise, John and I and our audience? How should we think about that? What we're trying to do is create this economic engine for people. And at the same time, every action has a reaction.
No, you're totally right.
How are you thinking about it? How would you advise we think about it?
Yeah, it's a really good question. It's so hard. Let's say we're right and shared ownership is this great thing. And, over the next period of time, I think in this instance, it's probably longer than a few years, but it does become a meaningful portion of the solution for folks trying to get on the homeownership ladder. You can't deny it's going to be another driver of demand. It's another thing on that side of the housing equation. I know this is such a common topic, but without a meaningful step change in new supply, new types of supply even, it's really hard to imagine whether it's shared ownership or anything else, not providing, upward pressure on home prices, right? I'm not one of those like never downers in terms of home prices, but I really think for this entry level segment, that's growing and people are just trying to get into some home anywhere, right? And often making would sometimes seem like odd trade-offs in terms of location, transit, whatever. If you can provide an option for something that's closer into where they work or where they want to be for, carrying out the rest of their life, it would be a demand driver. And absent any change fundamentally in supply, which is maybe even more intractable, it would be a support. The only other thing I would add is like, man, this market is so big. And in a world where you have basically subsidized 97% plus mortgages, I don't know that shared ownership at the margin would be worse than the existing demand instruments that are out there in place. In some ways, you could even make the case that on the second order, it might even be more sustainable and better for customers. That might be, a limb too far, but I don't know. There's really a lot of different edges to that.
Casey, I mean, you hit on something that I think is a really important thing to note, right? We have limited housing supply, and the housing supply that's available for sale, like the people buying it don't need help. Like I think still 25% of homes are being sold for cash. I mean, it's the people that are buying those homes do not need help. But the people that can't access those homes, can't even compete, really do need help, right? And I often hear the criticism of models like this, something along the lines of, well, we want people to own the whole home because they're going to build wealth. And the fact of the matter is people can't afford a $600,000 home, but they might be able to afford a $300,000 home and compete with those that can afford the $600,000 home. So, while we're waiting decades for the supply crisis to be fixed, the thing that this alternative really does is allow equal footing to the people that policymakers have been trying to help for so long with inane solutions like down payment assistance of $20,000, which is a drop in the bucket and is not going to allow those buyers to compete in this crazy market. So I just really want to stress that what you're doing is not going to help the rich people that need to buy homes today or help them buy the available supply. It is going to create equal footing for people that can't do that today. And to that end, and I'm sure you'll agree with this, we got to look to these policymakers and say, stop preventing these models from getting traction. Stop wasting your time with these other demand-side solutions that are really going to people that don't need it, and start embracing these new models and delivering solutions here, because we just can't wait for supply. We can't.
No, I think you're right. I think it's really hard on the supply side. And, I think for folks that are trying to support these types of products and types of initiatives in, large organizations that have a status quo. And, I try to emphasize and understand, like, man, like, you're operating in the billions, trillions of dollars, right? Like this is a drop in the bucket. And yet at the same time, little things that can be done to support it, even if they take a long time, they move the needle. I would be encouraging to policymakers and say, like, look, even if it's going to take a long time, let's stick with it. Let's make incremental progress, because it is going to take a long time. And your support, even if it's measured over a long period of time, what it's going to do is it's going to signal to potential platform builders, supporters, funders, is that there is an end in sight, right? I'm not just going to endlessly support this platform that's trying to make something happen and running into a brick wall. It's like, no, we're working on the door. There will be a door, and then the expected value of supporting things like this is there. I guess I try to be optimistic on these types of things. And you spend infinitely more time than me on the other side of it, and understand just how hard it is to influence policy and support these things from the inside. So I think it's just going to take a while, and just sticking with it and being encouraging that the juice is going to be worth the squeeze. It's just going to take a long time.
Well, that's why this conversation exists, because we agree. And that call to action, the way that John laid it out and you supported it just now, is exactly why we do this. Your name says it all. This is a path to equity. This is the path to equity for millions of people. And to stop that only stops progress. So really, really appreciate the work you do.
Yeah, Casey, just amazing to have you. Thank you so much for taking your time. A lot of great insights, and just felt that was just an amazing conversation. That will do it for this episode. We would love to hear from you, the listener. Please send us an email at podcast@thehousinginsiders.com. And if you like what you hear, we would love for you to leave us a review.
Please subscribe, get all of our episodes in your feed, and share with your friends. We want to get this message and these call to actions out to everyone.